You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back. Yet another episode, Young Investors Podcast. Hamish, what's cracking, my friend?
Not a lot. I was just listening to your podcast appearance with Investing with Tom.
Oh, yeah.
That sounded really, really good.
Absolute betrayal. How do you feel? I betrayed you for another podcast.
Yeah, I know. I was thinking that. I was thinking, man, is this going to be the first time that I'm doing the Young Investors Podcast on my own? Is Brandon even going to show up today? Yeah, so I was
No, it was good fun. It was good fun sitting down with Tom and having a bit of a chat. We've had Tom on the podcast before,
yes.
And everybody knows from Investing with Tom, he invests very similarly to what we do. So it was a really good discussion, just having a chat with him about all things investing and talking about YouTube and Tesla and all sorts, all the things that I like to talk about.
Yeah, I feel like
we'll have to get him back on the podcast at some stage, I reckon.
That'd be good. Yeah, we've got to have him back on again. I feel
we
like
need to get some more guests on. We haven't had a guest in a while.
Yeah, that's the other thing, right? We haven't really, we haven't sort of tried to get guests on in a long time. When was the last time we had a guest?
I don't know.
God.
It's been a fair while.
Yeah.
Maybe we need to get back into that. Anyway, maybe if the opportunity arises.
Yeah. We'll see at some point.
What you been up to?
What have I been up to? Oh, not much. The same as every other week.
How's your camera?
My camera is good, actually. Yes, I've used it for a couple of videos now. Still trying to tweak things and just make it look exactly how I want it to look and mess around with things. This camera has a lot more customization kind of options in the camera, a lot more settings that you can mess around with. So there's a lot you can do with it, and I'm having a lot of fun messing around. But it's really good. The file sizes are not good. That's one thing I've discovered. Recording in 4K.
Recording in 4K. Oh yeah, you're uploading in 4K. Let's boost you up. Oh, look at that crispy face of yours. Look at how sharp that is. So you have some sort of color grade that you put over the top of your footage?
Yeah.
Or do you have a preset, or do you do it every single time?
No, I have a preset. That would be painful to do that every single time.
It would be.
Yeah, so I just, for one of the videos, I made my own color grading, and the other one I used a package that I purchased.
Oh, right.
So,
okay.
Yeah.
Nice.
Just messing around.
Looking good. It's very crispy. Crispy fresh. But anyway, that's probably not what the listeners are interested in.
Probably not.
This is the sort of stuff that we're interested in. I like nerding out on technology and different gadgets and gizmos and whatever.
Yeah.
We should probably talk about the stuff that we're supposed to talk about. What are we talking about today? There's not a lot going on this week, to be perfectly honest.
Yeah, I mean, there was one really major thing, which is, of course, the US stimulus package.
That's true.
We have a little bit on US inflation and a couple other stories, but we'll probably spend a fair bit of time of this episode going through some questions. So as always, if you're not aware, if you have a question, you can get it on next episode by heading over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode. And if you leave your topics, news topics, or questions that you have there, we chuck them into each episode and usually get to answer a couple. We'll probably answer a few in today's episode. So that is what we've got for today's episode. Should we just jump straight into the sponsor?
Yeah, let's go.
Today's episode is sponsored by Sharesight. So Sharesight is an application that I've personally been using over the past few years to track the performance of my stock portfolio. And it will basically allow you to track all of the different types of gains you experience when investing in the stock market. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I personally use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So you can use that link to sign up to a free plan and use it for as long as you want. But if you want to sign up to a paid plan and get more features, you can also use that link to get 4 months free when you sign up to a yearly subscription, 33% off. So go check it out. Also, my the person I communicate with from Sharesight recently let me know that they hit 200,000 members. So
wow.
Congratulations, Sharesight.
Well done, Sharesight. That's pretty impressive. I mean, it just shows you that you make a good platform and, you will get customers if you make something that's genuinely valuable. So, no, that's good. Good to hear. Good on you, Sharesight.
Yeah, definitely.
Where should we start? I guess we'll start with the with what's going on with this US stimulus package, right?
Yeah, I think so. Take us through it.
Well, Joe Biden's, it says 2.5 trillion Australian dollars, but it's 1.9 trillion US dollars. So Joe Biden's $1.9 trillion US coronavirus stimulus package has passed the House of Representatives. So the article reads, US President Joe Biden has scored a major political victory after his mammoth stimulus bill passed the final legislative hurdle in the House of Representatives. The House vote was almost exactly along party lines, the Democrats securing the bill 220 to 211. Republicans in both chambers opposed the bill unanimously, with many arguing against the size and the scope of it. There will be direct payments for many Americans, as well as money for schools and businesses. For many Americans, there are provisions to provide up to $1,400 US direct payments this year to most adults and extend $300 per week emergency unemployment benefits into early September. The president thanked the House for passing the bill during a press conference on Wednesday night, local time. This bill represents a historic victory for the American people, he said. I look forward to signing it later in the week. Everything in the American Rescue Plan addresses a real need, including investments to fund our entire vaccination effort. So there you go. They finally did it. How long has this been going on for? Months and months and months and months, from well before Joe Biden was even in office. There was umming and ahhing and just back and forthing over this stimulus package, but it looks like that it's actually going through. So they've actually bloody done it. Finally.
Yeah, it's one of those weird things where pretty much everyone agrees there has to be some level of stimulus when you have restrictions in place by government, so people can't go to work or they can't fly or whatever it is. But there is also so much debate over what should be in it that it just takes so damn long to go through.
It's crazy.
I mean, Trump was trying to get that through for a long time. Last year. So yeah, it's crazy that they've finally got it through. But yeah, the Democrats have, what do they have? The House and the Senate. So
yeah, it's all blue now.
They anything they want to get through, they should be able to get through now, which is good or bad, depending on which side, depending on what they're passing, I guess.
Well, to be honest, like I kind of like it in a way. To be honest, I'd probably like it if it was all red as well, just because then things actually get done. I feel like when it's just, if the Senate's red and the House is blue, then just nothing happens. There's just a whole lot of, I mean, some people would argue, and I guess it's fair enough to argue, that could actually be a better solution, because then they need to, if they want to get stuff through, which obviously they do, they have to kind of work together and compromise and get the agreement of everybody. But still, generally speaking, like even using this use case as an example, if it's just back and forthing, then it's just so ineffective. It takes so long. And so little gets done when, there are people that are really struggling, obviously, financially from everything that's happened with the coronavirus and the pandemic and the shutdown and unemployment and whatnot, that sometimes, especially with these issues, you're just like, man, I just wish that one party had complete control so they can just get this stuff done. Because as long as there's toing and froing, it's just like the American people are the people that suffer because they don't get the stimulus, they don't get the financial relief that a lot of people really, really need. So that's kind of my take on it. What's your take on it?
Yeah, I mean, I think you need a little bit of both. I think it's good. Yeah. I think it definitely is good when there's periods where a party can get a lot done. But then I guess it kind of depends on whether you agree with what's getting done.
Yeah. Depends on what side of the fence you sit, I guess.
Yeah, I mean, there's certainly been governments around the world where they've had plenty of power to push stuff through, and they've used that power in a really negative way. So I think it is good that it goes back and forth. But I kind of agree with you that it would be nice to see, okay, if Democrats are in, they can get through most of what they want to get through, and then it goes back Republican and they can do the same thing. So it kind of goes back and forth, rather than just a constant stalemate where nothing happens and there's no movement in any direction. But very interesting to see.
You know, sorry, I was just butting in. The most annoying thing that I've found especially with American politics, is there's so much just like when Barack Obama was in, he did a whole bunch of stuff, particularly like Obamacare. And then Donald Trump gets in, and then the first thing Donald Trump wants to try and do is cancel everything that Obama did. Yeah. And now that Trump's out and now Biden's in, the first thing that Biden wants to do is cancel everything that Trump did. Yeah. It's just like, man, let's think about going forwards. Let's think about doing some new stuff and building on the past, not just, you know, if this continues, then eventually everything in America will be cancelled. You'll be back to how you had it 100 years ago, as everybody continues to cancel things that came before.
Definitely.
Anyway.
Yeah. I mean, certainly when there's things that need to get done, whether it's climate related or whatever, it's certainly frustrating to see it just kind of go back and forth like that. But then I mean, to me, it lands on both sides, because there are, I think, at least in my view, there's a lot of things to like about like let's say regulation or the legal system that say the US or Australia has set up. There are parts to like. And if it doesn't move too much in either direction, then those things are preserved. But at the same time, there's things that what you want to change. And those things typically don't get changed very quickly or ever.
I found interesting, I listened to the Joe Rogan podcast with Elon Musk. Elon Musk has a pretty interesting take on how governments should act. His opinion is that governments should almost just act as a referee, try and do, as strange as this sounds, try and intervene as little as possible and act as the referee, where they just make sure that everybody plays by the correct set of rules. And he's saying that one of the problems he sees with government at the moment is that there's, you know, you'd never want to have, or he talks about this with governments and regulators as well, is that you never, in a sports game, you'd never want to have more referees than players on the field.
Yeah, I remember.
So he's saying that it's getting to a point where sometimes and in a lot of cases with business as well, governments they have a stake in these different areas of business as well. So it's like actually now the referees are also their own team on the field, which is kind of strange. So his opinion is that governments should just solely act as the referee, keeping things clean and making sure things work by making the right rules.
Yeah.
And then let it kind of figure itself out through a more free market system. And that, he sees one of the big problems now is that governments are being so active that they're becoming their own teams, and there ends up being so many referees. It's like one of the examples he used was the amount of regulation Tesla faces in California. And he definitely feels in that case like there's more referees on the field than there are players. And that has driven all of the players to go and play the game in a different state. I think Tesla's like the last auto manufacturer left in California or something like that.
Yeah.
But I found that interesting.
Yeah, I mean, that is very interesting. I think if you look at any industry, if you look at like the level of highly regulated industries, they're usually not very competitive, because when you have all these complicated rules and hoops you need to jump through, it makes it really hard for open and free competition to kind of take place in those areas. So, I certainly understand what Elon's saying there. Which episode was that? Is that from? He's done a few now.
Yeah, it's his most recent one.
This is his most recent
What was it? It ended in 2009, so whatever they're up to recently, whatever numbers they're up to, ends in 2009.
Right,
I think.
okay. Yeah.
It was from like a couple weeks ago, 1-2 weeks ago.
Yeah, I don't think I've seen that full episode. I think I've seen part of it.
Yeah, it went for 3.5 hours.
Really? Wow.
Yeah. How insane is that? Yeah,
that's great.
I should look it up. Joe Rogan Experience. I'm actually learning a lot, not even just from what Joe Rogan talks about and the guests he has on, but it's really interesting listening to the tactics and the way that Joe Rogan talks to people in order to get them, talking and about different things. It's actually really interesting. I'd almost describe Joe Rogan as like a conversationalist. Like he knows, he really understands how to talk to people and to lead them to explain different things. I just find it really interesting. Sorry, a bit of a tangent. 1609, 1609, Elon Musk.
Fantastic.
Yeah, it's a long one, so gear up. You might have to watch it and listen to it in a few sessions if you want to listen to that. But it was very, very interesting.
One other thing I had for the stimulus was I noticed, I read an article that said the US deficit has now hit $1 trillion for the first 5 months of the fiscal year. So the fiscal year that they track for their budget starts in October, I believe.
Right.
So the first 5 months, the deficit is at $1 trillion, meaning for those who don't understand deficit, basically that's how much they're spending compared to the tax revenue they're generating. So they're basically spending $1 trillion more than they're actually generating from taxes and other means. And that figure needs to be compared to something, because when I saw 1 trillion, I was like, wow, that's really high, but what is it normally?
Who knows?
Is it normally 2 trillion? Is it normally 100 billion? But in the same period last year, so this was before the pandemic, remember? So this is fairly, I guess, a good example of a typical year or something. That 5 month period was 624 billion. So 1 trillion is whatever that is, about 40%. Oh no! Wow, almost 100% increase.
Yeah.
Wow, 80% increase or something like that.
400 billion. Yeah.
Yeah,
that's crazy. And I guess there's going to be even more coming through, right?
Yeah, you would
with all the stuff with the plans that they have.
Yeah, exactly. Like this stimulus package isn't money that's being spent today. It's a plan to spend money over the course of the year, but then also I think some of these things last even longer than that. So
right,
yeah. Definitely a big increase in spending. And I guess that might be a good segue to move into something I wanted to talk about, which is the inflation numbers, which came out this week. Of course, this is a number that a lot of people are watching because government spending is at record highs, essentially. And a lot of people are concerned that this will drive inflation. So this week we got our monthly numbers for the change in the consumer price index, which is what inflation tracks. So the consumer price index, for those who are unaware, is basically a basket of household goods and services, and they track the prices of that. And then they compare it to the previous month or the previous year, and that gives us an inflation figure. So for the 12 months ended January 2021, this was the number that we had previously. So it's always tracked on or in this case, it's mainly tracked on a 12-month period. So the last, at the end of January, it was 1.4% in the United States. This is. And at the end of February 2021, so the latest number that we have, it's now at 1.7%. Inflation.
It's
so
creeping.
It's gone up a little bit. It's still,
but it's still, like, for context, that's still very, very low. I think if you look at inflation rates in most places, I know definitely in Australia since the year 2000, I think the average annual inflation rate has been around about 3% to 2.7%. Somewhere around there. So even though you go from 1.4 to 1.7, I think once you give that context, it's actually still quite low. So
yeah.
But it's creeping, isn't it? It's creeping.
Yeah, most developed central banks have kind of reached an agreement that between 2 and 3% inflation is kind of your ideal range for stimulating safe, consistent economic growth. So 1.7% is still below even the normal level. So we're not even anywhere near considering inflation that is, we would start to say, is getting too high. So that's interesting, although it is kind of, I guess, trending in the upward direction. But we can also look at what is driving that change. So looking at specifically what prices, what goods and services have changed in price. So half of the increase was driven by an increase in gasoline prices, so petrol prices in the United States, which was up 6.9%. So that's the biggest inflationary part of the consumer price index that was seen. Energy rose 3.9%. So again, that's pretty high. The core CPI, the core consumer price index, which excludes food and energy, rose just 0.1%. So if you're excluding food and energy, then there was basically no increase. And on the declining side, because of course, even though it increased overall, there are some components that decline. Airfares was the biggest decline, 5.1%, which is very interesting, but not unexpected. There's been a lot less demand for flights, and as a result, airfares have, on average, come down over the past year.
Yeah, it makes sense. And I think it's worthwhile actually having a look at the different components of the CPI that makes up inflation. Because I remember there was one quarter, a couple of quarters ago in Australia, where we actually saw deflation. Everyone was losing their mind and going, what the hell? The deflation is I'd rather have inflation than deflation. But actually, once you broke it down into the different components of the CPI, it just so happened, you remember that time where there was like all of the world's oil storage was full?
Yes.
Do you remember that?
Yeah.
So, and then the price of oil just fell off a cliff. Yeah. So that was a massive component. But on top of that, like the Australian government did some sort of stimulus thing where childcare, they made it free or something like that.
That's right.
So childcare got taken, like essentially had 0% on the CPI. And there was like something else, which I can't remember, but those three things happened at the same time, which stacked together actually pushed us into deflation. Even though when you look at it, you could say, oh, well, that's not going to last. That's not going to last. That's not going to last. We should actually be in inflation. So I think it is worthwhile actually breaking it down and trying to figure out why, and whether whether these trends are likely to continue or whether this is a once-off thing, particularly with something like gasoline prices. Like that was just unprecedented drop off a cliff in price last. I can't remember when it was. I can't even remember.
Yeah, I'm not
Sometime
sure.
last year, but we knew it was going to bounce back up eventually.
Yeah.
So you can't like those sort of things. You should see them and be like, okay, so I shouldn't really read into this too much. It's not like gasoline prices are going to go down by 30% every quarter for the next 10 years.
That would be kind of crazy.
That would be ridiculous. The death of the oil industry in 2 years.
Oh, and it's gone.
Yeah, see ya.
No, but I think that's actually a really good point. I think it's really important to not just look at the inflation or the increase in the CPI and just take that number for what it is. You really need to look at the context behind it in what you just described, which is looking at the breakout of it to see if there's any anomalies or outliers or anything like that. But there's also something else that's kind of related to the pandemic, which Jerome Powell, the chair of the Federal Reserve, spoke about. I think it was the week before last week when he gave a little speech. He actually said that we should be expecting to see an increase in this inflation number over the coming months. But he said that this is going to be an outlier because basically the consumer price index was so low during the onset of the pandemic that when we start to look at year over year increases in the consumer price index, and we have...
It's going to look drastic.
It's going to look drastic because you're going to see the effect of a lot of price declines, actual deflation that happened during the onset of the pandemic, as demand was just kind of smashed across the board, or in particular industries as well. But that is something to note as well, particularly I think starting next month when we get March numbers and then April and then May, we would expect to see that the official inflation number will creep up. But whether that remains high, we don't really know. We'll have to kind of just wait and see. It's one of those numbers that's fun to watch, but like we have no idea what it's going to do in the future. Yeah. We can't look at the trend in the past and say, oh, look, it's going up, so it's going to go up another 0.3% next month. Like that's not something you can do with inflation rate. It goes up, it goes down, it bounces all over the place. So you just kind of have to watch a trend over time, and you always, it's one of those numbers you're always looking backwards on. You can't predict where it's going to move to in the future. So
yeah, and it's something that. This is something that me and Tom talked about yesterday. It's something that is very firmly sitting in the macroeconomic area. And when it comes to us looking at individual businesses to buy and thinking about it, our own investing, it's not really something that should factor in heavily into your investment decision, because we're just looking at companies on a kind of case-by-case basis. So this is kind of like something that would get Ray Dalio really hyped up, looking at interest rates and inflation rates and yada yada at the macro level. That's kind of what he really likes. But when we start getting into Warren Buffett, Charlie Munger, picking individual stocks, evaluating individual businesses for our own investing, it's something that we should be aware of, but it's not something that we should be like, oh my gosh, I can't believe it, I'm not going to invest because of the inflation rate or something like that.
Yeah, definitely. Yeah.
Cool. Well, should we move on?
Yeah, where should we go?
Move on into this next. This is kind of like a story, non-story kind of thing. I just found it interesting. Virgin is starting to eye off international travel. There's a couple of interesting little tidbits. I think this is from an interview with their CEO. So it says here, Virgin Australia hopes to be at 80% capacity domestically by July, allowing it to secure more than 1/3 of the airline market and make a bold attempt to resume international travel. So it's pretty interesting, actually. Now that Australia is starting to get, we're starting to get our hands on vaccines, all of a sudden there's this buzz about, it could be quite soon that we'll actually be able to get out there. I work with, I don't work. One of the participants in my class is pretty high up, I think, on the coronavirus, I don't know what you call it, task force. And apparently there's like quite a push to get, I think all of the like essential workers and the elderly, they want to get vaccinated within like the next month or two.
Wow.
And then having like a very large percentage of the population vaccinated by like the end of the year. So that would be interesting.
Yeah. Hopefully they can get this, stick to that timeline. I think in the US, they're hoping to be completely vaccinated by just after the middle of the year or around the middle of the year or something, which is crazy to think about. But
that's quick.
Yeah.
That's what $1.9 trillion can do. So I found this interesting, and hopefully this vaccine we can just all get it without too much difficulty, and that can almost instantly hopefully open up international travel again. The article here is the nation's second largest carrier's confident vaccine rollouts will prevent further state border closures and allow the embattled airline to compete as a mid-market offering between its main rivals, Jetstar and Qantas. The airline's top boss, who used to be at the helm of Jetstar, said the expansion of its Velocity Frequent Flyer program would be vital, especially when the airline kickstarts short-haul international routes when border restrictions ease. Quote, "We are looking forward to short-haul international flights coming back. It will be one of the first things we do. It will be anywhere a Boeing 737 can fly, so that will include New Zealand, Fiji, and Bali."
Right.
So that'll be interesting. We can go on holidays. The only thing that's missing, annoyingly, in this article is a timeline.
Yeah.
So like hyping up. Yeah, they say about the 80% domestic capacity by July, but in terms of international, they're like, oh, it'll happen soon. But I just wish they said, oh, we predict it will happen then. But maybe they don't know yet. So who knows?
Yeah. Very interesting. But who knows when all of this is gonna take place.
Yeah.
Exactly right. I am looking forward to going overseas again, though. At some point.
It's such a case of you don't know what you got till it's gone.
Yeah.
Because before, when I had the freedom to go wherever I wanted, I could just book a plane ticket and go. I never really went anywhere. I kind of just was just chilling out, working here. My holidays, I might go, to New South Wales or to Queensland or to Melbourne, but I would never really go to Europe or America. And now that that option has been taken away, all of a sudden now I'm like, oh, I want to go to in this country or that country. It's like, no, we can't. It's pretty funny.
Yeah. I don't know
where would you want to go? If all borders were open. Where would you go?
I don't know. Probably in Europe somewhere.
Europe?
Yeah. If everyone's vaccinated and it's all that's going to be a while away. I'm guessing I probably won't travel internationally for at least 12 months, probably 18 months. So it's a while away, but yeah, Europe somewhere maybe.
I remember us talking about we wanted to do a big US adventure.
Yeah.
Go over and hang out with all the other YouTubers over in the States and go do collaborations with all of them and just hang out and go to FinCon or something. But man, that idea got shot down.
Yeah. Won't be doing that for a while, unfortunately. Yeah.
Yeah.
Oh, well.
Maybe one day.
Maybe one day.
Hey, what are we talking about with Facebook?
Yeah, so we've got a little bit of an update
going on
on Facebook's antitrust case, which was initiated by 48 states and the FTC. All went in on this case against Facebook to argue that they have stifled competition and hurt consumers as a result of it.
This is the one. Is this the one where they were saying like, oh, you bought, you're so big, you bought Instagram and, stifling competition, when they actually bought Instagram like way before it was a competitive behemoth?
Yeah, exactly. Instagram and WhatsApp are the two big acquisitions they're looking at as whether they were anti-competitive, whether they were just trying to buy all the competition and maintain their competitive position in that way. But we've got a little bit of an update, a little bit of a non-story as well. But Facebook has started this. They've basically started the proceedings off by asking a federal court to dismiss the case. So that's kind of the first move that anybody makes. It's always a long shot because it's the best outcome if you can just have the case dismissed before they even get a chance to present their case. But Facebook basically argued this week that it faced ample competition and that the FTC and the 48 attorney generals from states and territories could not prove that the company had harmed consumers. So they're basically saying that they have no way that they can prove that we've breached antitrust laws or acted in an anti-competitive way at all. And as a result, you should just throw the case out. And the article that I was reading, of course, said that it's very unlikely that the case will be dismissed because when you're asking for a case to be dismissed, it comes with a significant burden of proof. So Facebook has to actually present proof that beyond, in a significant way that the government shouldn't even have the opportunity to present a case, which is a very unlikely to go through. Something I found interesting, I assumed that if they present that argument in the courts, that the FTC would kind of come back relatively quickly, if not on the same day. But apparently the FTC's response will come in April. So,
what the heck?
Yeah, so they have a month to respond, which is just a perfect indication of how long this is going to go for. This is going to last for years because even just a dismissal, which both parties are probably expecting that it's not going to happen, and then they'll move on to actually starting the case. Even that is going to take multiple months to go through.
That's ridiculous.
It is. Yeah. It is kind of absurd how long stuff like that takes. I guess there's just a lot of cases going through the courts, and there is a lot of prep that goes into these big cases. I'm sure Facebook's punching millions of dollars, tens of millions of dollars, if not more, into fighting this with a huge legal team. And you have the US government, which I'm sure they have quite a lot of resources, as we spoke about earlier. It still takes a long time for these things to go through.
Yeah, it's crazy. Kind of reminds me of like people that in other countries that are likely going to be sentenced to death for some crime. And then it's just like, right, okay, we just have to try and drag this out for as long as possible. Dear. But yeah, it's just insane how slow these things can go. It's crazy. I mean, I remember do you remember the Essendon Football Club drug scandal thing from years ago? That was like, I remember because at the end of that year, a few of those Essendon players got traded to Port Adelaide, which is the club that I follow. And then the players played for Port Adelaide for a little bit. So they had switched teams and they were continuing to play. And then after a while, then they got banned for a year. So I remember at the time, because I was like, what? How is this fair? We're getting penalized because something we didn't like, our club had nothing to do with. But anyway, it is remarkable. I remember it was like 2 to 3 years after that scandal happened, then they were like coming to a resolution. It's just like some of these legal things, it's just unreal. These investigations and Oh, why does it take so long?
Yeah.
Anyway.
It'll be really interesting to hear when we start to get into kind of the meat of the case. There will be a lot of it that we won't see just because there'll be confidentiality on some of the stuff that Facebook will be handing over to the government and then the vice versa. So we won't see all of it, but it'll be interesting to start to see some stuff come out of it and see what case the government is presenting and what their evidence of it is and whether that's reasonable, and then Facebook's rebuttal to that. That I'm excited for. Unfortunately, it's not something where you get to just read in one news article on one day. It's something that you kind of watch over the course of 2 or 3 years. So we'll see what happens. People are calling this the biggest antitrust case since the Microsoft case 20 years ago, and that did not end well for Microsoft. So we'll just have to see what happens.
Yep, indeed. We'll have to wait and see. There's going to be so much to talk about, but we'll just have to wait for it. What's happening with Thor?
Yeah.
You're going to keep rolling on into Thor.
Yeah.
This is interesting.
So they reported their second quarter earnings. And I mean, I know Thor's probably not a company that most people are even familiar with, but it's one of my investments. And what's happening with the industry is just so fascinating to me that I thought we could talk about it when they reported their earnings, which they did
absolutely
this week. So revenue for the quarter came in at $2.73 billion. So Thor Industries, for those who are unaware, it's the largest RV manufacturer in the United States. So they manufacture about 50%, about 1 in 2 of the RVs purchased in the United States. And their revenue came in for the quarter at $2.7 billion, which was up 36% year over year. So, and that 36%, of course, is an increase in a quarter that was before the pandemic. So this isn't some artificially high number. It's actually comparing their revenue from the second quarter before the pandemic to after the pandemic. So
that's insane.
Yeah, so they've seen a significant increase in demand as I think I've spoken about this on a couple of other episodes, but clearly a lot of Americans are deciding that since it's very unlikely they're going to be able to travel internationally as much and as freely as they originally planned to over the next few years, that a lot of them are just going out and buying RVs and deciding to travel within the United States for the next few years. From state to state, yeah. So 36% year over year increase is huge. But the most stunning thing to me about this was that even after a 36% increase, they're still not keeping up with demand. And what I mean by that is they have a figure called RV backlogs, which tracks all of the orders that have been placed, but they have not fulfilled yet. And just to give context, they usually fill orders within 30 days. So if an order is made in a quarter, it's usually fulfilled in that same quarter. But backlog orders increased from $8.9 billion to $10.8 billion, which is a 280% increase in backlog over last year. So their backlog is up massively. And even with a record quarter, so even producing or selling $2.7 billion in RV worth of RVs, they could only produce about 60% of the orders that they received, which is crazy.
That's it basically a sign of demand, isn't it?
Yeah, I mean, it really just means if they had no limit on their production, on their ability to produce the RVs that people are demanding, they would have seen an insane increase in their revenue figures.
That would have been ridiculous growth.
Yeah.
I wonder do you know how much like an RV costs?
Yeah, it depends on the class. So you have there's kind of 3 classes of motorhomes, which are all relatively expensive, ranging anywhere from $50,000 to $300,000. The towables, which are the most popular, that's just your typical caravan you hook onto the back of a car.
Yeah,
they average about $30,000. So they're on the cheaper end, and I mean most people, the vast majority of people, buy an RV secondhand because you can get them from like $10,000 to $15,000, and it's just as good as a new one in many cases. But yeah, for brand new ones, about $30,000 is like the most common purchase that somebody's making.
Right.
Yeah.
Yeah. Look at this. I'm looking at some now. These towable ones look, for anywhere from, 30 to 80,000, Man, some of them you see though are like full on luxury homes on the back of like on this little truck thing.
Yeah.
I reckon if Tesla made an electric RV, I would be so down for that. I would buy one. Just scoot around Australia in my Tesla RV.
Yeah.
In motorhome luxury.
Yes. Some of the class. Sorry, go on.
Sorry.
I was just going to say some of the Class A motorhomes, which are the very high end RVs, are just ridiculous. They're just insane.
Yeah.
But what were you going to say?
I was just going to say, do you know how many units they're producing?
Not off the top of my head.
Not off the top of your head, right? Okay, that'd be interesting. So I actually don't even know like how, like obviously they're doing very well with their revenue and their order log keeps growing, but I wonder like what the actual unit numbers behind that are.
Yeah,
right.
yeah. So for the North American industry, I know that figure. So that's expected to do about 510,000 units. So in terms of units, it's quite a small number, 500,000 units for the entire North American industry. But that's obviously to be expected. They're very expensive vehicles,
and it's a bit of specialty as well, isn't it?
Exactly. It's not
like not everybody gets one. It's not like cars where they sell millions and millions, tens of millions each year.
Yes, exactly right. Yeah, so Thor would be producing about I think about 40% or 45%.
Okay, pretty good market share though, man. It's pretty impressive. Obviously, I don't know anything about the RV industry, but it sounds like that would be pretty good market share.
Yeah, I mean that's initially one of the things that attracted me to their business was they've just had such a strong market share position for so long, and every time there's been a newer, smaller RV company that's doing quite well, that's kind of starting to look like it's going to be a decent competitor. Either Thor or Forest River, which is owned by Berkshire Hathaway, either one of them just acquires that smaller, successful RV company. So it is.
Well, they made a big acquisition, didn't they? Thor, that other RV, was it a European RV company?
Yeah. So they acquired Erwinheimer, which is I believe it's the largest RV company in Europe, and they mostly sell out of Germany. And that was kind of their first move internationally. So up until then, they'd just been strictly in North America, in the US and Canada. So that was their first move to move internationally.
That was big news at the time.
Yeah.
But they did it in an attempt to gain further, like really try and get a dominant market share number. Is that right?
Yeah. And I mean, that's been their strategy. The entire time that Thor has existed over the past 40 years is to acquire really good companies and have them operate in a decentralized model whereby even though they own a bunch of brands, they all operate independently with independent management teams and they all compete against each other.
Okay.
So it's a very interesting model. I think Thor is one of those examples where the management team is it shows how important management team is to the success of a business, because I think they've made probably like 30 acquisitions over their lifetime. And if you don't have a good management team to get good deals, that's just not going to work out for the vast majority of businesses.
That's a good point, actually, that I haven't thought about too much before. If you're going to be a company that focuses on acquisitions, then you better hope that the management team is competent. Because if you're a company that grows non-organically, so through acquisitions, and you have a rubbish management team, then that would destroy your shareholder value pretty quickly.
Yeah, exactly.
I've never really thought about that before, but that's an interesting point.
Yeah, I'm pretty sure in one of Warren Buffett's essays, one of his shareholder letters, I'm pretty sure he says that you should typically stay away from businesses that do a lot of acquisitions, because the vast majority of the time they just end up being terrible acquisitions, or it's a company where the management team changes too much. So the acquisitions are being made by different management teams over time, and they don't really care too much about whether it's good long-term because they're not going to be there in 5 years. So there's a very select few businesses that can make a lot of really good acquisitions, and Thor's just been one of those that has a really good track record of it.
Yeah. Oh, very interesting.
Yeah.
Good update.
I think we should get into some Q&A.
Yeah, let's do it. Let's do it. You want to pick a question?
Yes. Where should we go? Should I do this last one?
Yeah, why not?
Okay.
This is a very, very long question. So we'll just try and shorten it down to what the question's actually asking.
Yes. Yeah. So I'll just read the last bit, which I think is the question. I can't predict when or if a correction is imminent, but what is your thoughts on an inverse or bear ETF? For example, the fund expects to generate a positive return when the ASX 200 index falls. So it works inversely. Is that the rest of the question, or is there more? You'll be.
Oh no, that's basically it. That's the crux of the question. Yeah, it's basically asking what do we think of inverse ETFs, especially with the market by basically every measure under the sun being very, very pricey at the moment. Is it worthwhile, looking into some sort of inverse ETF? I personally don't look at inverse ETFs. I mean, the idea is there, and it makes sense. If the market falls, then the inverse ETF goes up. So for a lot of these inverse or bear ETFs, if the market fell 5%, you just made 5% by being invested in these inverse ETFs. The only thing is that I think these ones are the ones that get rebalanced daily. So they're definitely not, you don't hold them for a very long period of time, because if you look at the long-term performance of the stock chart for an inverse ETF, it will not look very good because they get rebalanced daily, so that every single day they try and generate the exact opposite return of a particular index. So that's one risk, is that they're only ever short-term investment vehicles, those ones. But I don't really look at them for that fact, is that they're not useful for the long term, and it means that you really are trying to time the market. There are other, even more scary, is the leveraged inverse ETFs, where you can actually get like 2x or 3x amplification of the result. So if the market goes down 1%, you could go up by 3 or 4%. That's where I think it gets really scary, because then you've got this short-term investment vehicle. So you literally have to time the market pretty well. And it's also like super I don't know. It's just not for me. It's just a bit scary for me.
Yeah, I'm definitely in the same boat. I think whenever I'm investing in anything, I'm thinking long term, and whatever happens in the short term, I really don't know what's going to happen. So if I was buying this ETF, I would have to have the opinion that say the ASX 200 in your example, I'd have to have the opinion that over the next 10 years, I was confident that the ASX 200 would be lower than it is today. Which I don't even know if, as you described, I don't even know if you can use an inverse ETF to do that. But I obviously don't think. Not really. I obviously don't think that's the case. Anyway, this would be something, as you said, that you would use to if you expected a short-term negative movement in the ASX 200, which is something I don't think you can predict.
Yeah. No, it doesn't work long term because of that daily rebalancing. I forget exactly how it works, but it's like, imagine they draw an example where if the market goes down like 3%, then it goes up 3%, and then it goes up this and then down that. There's one example where it's like, in reality, you would get back to 0. So they over 10 trading days, they put out this scenario where it's like down, up, up, down, 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 up, down, 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 up. And then you get back to 0% return. You get back to where you started. But in an inverse ETF, you basically always end up at a negative because of that daily rebalancing. At the end of each day, they rejig it so that the next day it does exactly what it needs to do. Yeah, obviously you can hear me talk about this. I'm no expert in inverse ETFs, but that's just the small amount that I know about, and I just steer clear.
Yeah, I mean, that actually reminds me. A lot of the time, people will ask me about just all of these different little things. Like I understand what SPACs are now, but like before SPAC, what's a SPAC, and what's this obscure leverage 3 times inverse industry tracking ETF? Like, there's a lot of things that I have no idea about. The vast majority of things, but I think a lot of them are just often, at least this is my opinion, I think a lot of them are just distractions from what really matters, which is if you just want to participate in the market, it's very simple what you should do. And if you want to actively invest, then worrying about all of these different products and new exciting IPOs and SPACs and all of these things is just going to be a distraction. Focus your time on understanding more about the business that's behind what you're going to invest in. So that's why I don't really know anything about this. I've never researched an inverse ETF, and I probably never will. So
yeah. Yeah. No, fair enough. All right, should we move on to a different question?
Yeah, sure.
Let's have a look. What have we got here? What one should we do? How about we do this one?
Okay.
Hi guys, I have a question regarding shareholder equity. I was recently looking into Domino's and was surprised to see that their shareholder equity has been negative for the past decade. Can you explain what it means to have negative equity and how it might impact a potential investment? Thanks for the great content.
That's a good question. There's probably a way better explanation than I'm about to provide on Khan Academy or somewhere on Investopedia or something. But negative, I mean, just as plain as simply, negative shareholder equity means that the company has less assets than liabilities. So the equation assets minus liabilities is negative. And what that usually means, it can happen in a couple of contexts. One is it could be that the business is not profitable. So as a result, a year rolls by of operating and they lost money, so the cash went down, but they still have debts that need to be paid. That could be a context in which equity could go negative. A more common context that's likely applicable, I haven't looked at Domino's, but this is likely the case. I would say it's more likely that because their business is doing well, that they've decided to distribute a lot of their assets, their cash, as dividends or share repurchases. So in that way, you can get to negative equity by taking on debt and then paying it out to shareholders and assuming that the business never faces a bump in the road and they can constantly make the payments on that debt, then they can operate with negative equity. The risk, of course, is that they are relying on being profitable consistently in the future. Because if they don't have assets, if they don't have cash to cover the debt, for example, on their balance sheet, then to cover that debt, they need to produce profit, right? So it's, we like businesses, or at least I like businesses, I won't speak for you, but I like businesses that have a substantial amount more assets than liabilities. So in other words,
I'm in that camp as well.
Very positive equity, because it means that even if it's not all in cash, even if they have assets in buildings or in property or in machinery or in inventory, even if they have assets in those ways, it's nice to know that in a pinch, in the worst case scenario, they could cover their debts and that we won't lose our entire investment. So it's kind of more around the financial health of the business.
I just looked this up on Investopedia to get a better understanding. I'll read you the key takeaways part.
Okay.
So it says shareholders' equity, also called stockholders' equity, represents the equity the shareholders own in a public traded company. Yep, we know that. Companies calculate shareholders' equity by subtracting the total liabilities from the total assets. Yep, we've got that. Negative shareholders' equity is a red flag for investors because it means the company's liabilities exceed its assets. So that's what you said. Reasons for a company's negative shareholders' equity include accumulated losses over time, large dividend payments that have depleted the retained earnings, and excessive debt incurred to cover accumulated losses. So that's basically what you're talking about.
That was actually pretty good. I swear I did not read that article before I answered that question.
You go. No, you nailed that. Shareholders' equity is significant to investors because it reveals the company's net worth, which is important to consider before investing in stock. Yeah, there you go. Man, you nailed that.
My finance degree, or the part of the finance degree I completed, I should say, taught me well, at least, to answer that question.
Nice. Should we do one more or should we leave it there?
Let's do one more. All
right, sure.
Where should we go?
I don't know. You can chuck this one at me if you want.
Brandon. Speaking to you directly, Brandon.
Uh-oh. I'm in trouble with this one, guys. This is a nasty one. All right, go.
Hit me. When the opportunity arises, you never fail to mention that you won't invest in an oil company because of your impressive ethics and values. Wow, this actually is an attack on you, okay?
I know. That's what I'm saying.
Then I can't help but laugh whenever you make an update video on your own channel about an increasingly impressive sum of money that you've made in a given month or a year. because I wonder what listeners think when you've talked about happily taking generous taxpayer money via the government JobKeeper pandemic program, money that you evidently didn't need, money contributing to a national debt that will have to be repaid by future generation Australians. Maybe being a little less heavy-handed, proclaiming your solid personal ethics would go down a bit better. Wow.
How's
Cop that? How dare you?
Cop that.
I know. How dare you and your increasingly impressive sum of money?
Yeah. But I did want to put this one in because I have copped this a fair bit because when the JobKeeper thing came around, the first time it came around, I was eligible for it. And they're definitely like this person, I can understand where they're coming from, although they're being a little bit angry about it. But I can understand where they're coming from because I said this in the video that I made as well. I'm the first to put my hand up and say that I really shouldn't have gotten that payment. Like I shouldn't have been eligible for this stimulus because I'm very fortunate that, that the YouTube channel is doing well and I actually wasn't impacted. In fact, I benefited financially from the pandemic and the shutdown. So I am the first to put my hand up to say that I really shouldn't have been eligible for that money. And for people that maybe think similarly along this line, I just wanted to discuss how this situation actually came about for me and my employer. So I got the JobKeeper payments through one of the gyms that I work at because the gyms were shut down for a period of time. And there were no rules saying, I wasn't eligible as a business owner. I wasn't eligible for all the stuff that I do from YouTube and Profitful and whatnot. There wasn't a drop in revenue there. But I was eligible from an employee standpoint from this gym that I work at. And essentially what happened is that one of the managers at the gym just sent around this document that we just had to fill in. And it was just asking a bunch of different questions that we had to essentially say yes or no to. And so they sent around this document and it was like, blah, 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 how many hours how long have you been working here? Blah. And I just filled in this form and then sent it back. And then the manager was just like, okay, we've deemed you eligible for this JobKeeper payment, so we're going to submit, you as an employee that was going to get it. And so that's how I ended up eligible for JobKeeper, and I ended up receiving the payments. But I do think, first of all, I think it's important to remember that the JobKeeper payments it's not actually for employees. It's a scheme designed for employers. So what my work did is it went around and tried to get a sense of how many eligible employees they had for JobKeeper. And then they submitted that documentation to the government for the employer to get their JobKeeper payments. The only reason it benefits the employees is because the government says that 100% of the employer's JobKeeper payments has to be passed on to the eligible employees. So that's how it ends up in the employees' pockets. But really it was a scheme designed to ensure that businesses could retain their workers during the lockdown. But anyway, so that's how I ended up being eligible for it. And I've said it before and I'll say it again. I am the first person to put my hand up and say that this system, it was a little bit broken, and it probably still is a little bit broken because I really should not have been eligible for that based on my financial situation in the lockdown. But I think, I will say, I think that when it comes to eligibility criteria for government schemes, I don't think you should necessarily, if you're eligible, you shouldn't feel like you should say no to an eligibility, like something you're eligible for just because you feel bad about. So it's kind of like the example that I draw here is you think about somebody running a business that has a lot of tax deductions versus someone that just goes to work every day and doesn't have a lot of tax deductions. It's like the person that doesn't have a lot of tax deductions could say to the other person, man, your business is doing so well that you shouldn't really be making those tax deductions, because that's just really putting the burden on the other taxpayers, you know? But of course, you get where I'm saying.
Yeah,
it's like, well, it's just the fair, I'm just doing everything within the rules specified by the government. It's like nobody, if you're eligible for a tax deduction of some description, of course you are going to put that in your tax return and lower your tax bill. I mean, that's just like everybody does that. So I kind of think in the same vein of that is that it's more about the rules. I think the rules need to be changed. And I would actually say that in the case of JobKeeper, even though I benefited from it, I believe that the rules of JobKeeper should have been different. They should have done some sort of eligibility criteria where in any instance, they take an overall snapshot of your financial position. And if you are in a healthy financial position, no matter what's happened with your employment, then you probably shouldn't have been eligible. And that would have kicked me out straight away. And I would have been fine with that happening, but that's not what happened. So anyway, that's kind of my story. That's how it happened. I thought I would kind of go into a little bit more detail on the podcast. But what do you think? I'm interested to hear your thoughts, Hamish. What do you think about that?
Yeah, I mean, I certainly just agree with you in that. I mean, I think it's fine to disagree with the rules that are being set, but once the rules are set for like what deductions are allowed or what tax brackets you're in or what exemptions there are or whatever it is, if they're the rules, like I don't see how you can. I don't see anything wrong with someone maximizing their own or keeping as much of what they earn within the bounds of the rule. Like I would just be more angry at the rules than the person. Than the person using the rules to reduce their tax, for example, or something like that. So I don't know. I don't really have too much thoughts beyond that, I don't think.
No, I'd be interested to hear. Like, I'm totally, if you think that I was wrong in taking this JobKeeper payment, I'd be interested to hear what you say. So let us know. Head over to the comment section of the YouTube version of the podcast and let us know. What do you think? Was it wrong of me to have taken on the JobKeeper payments? Do you think more like how we think, where if you're eligible for something, you should just take it, and then it really should be the rules that change? I don't know. Like, I'd be interested to hear your thoughts, because obviously I think one way, Hamish thinks one way, but I'd be interested to think if you guys think the same way or if you're different. But I think that's probably enough for one podcast for one day. Whew.
Definitely.
We thought we were going to have nothing to talk about today, and it ended up being another hour-long podcast.
I know, we say this every single week. We're like,
we don't
have anything to talk about, and then we ramble on about some obscure thing for like 15 minutes and fill the time.
It's so true, isn't it? We just find something to talk about. I don't know. Yeah. It's always on paper. Yeah, we're just like, this will be like 45 minutes. And just something catches our attention. Anyway, that'll do us for today, guys. Thank you very much for tuning in and listening. As we always say, thank you very much for the hour that you give us every week to listen into the Young Investors podcast. We really do appreciate it, and we hope you get something out of the podcast too. We hope you enjoy yourself, maybe a little bit of entertainment along the way. And thanks to Sharesight as always for sponsoring. Head over to what's the address? I forget every time. Sharesight.com/young investors.
That's it. That's the one.
That's it. Remember, any comments, questions, discussion topics that you would like us to address in the podcast, leave that all in the YouTube version of the podcast. Go to the most recent upload on the Young Investors Podcast YouTube channel. Leave us a comment, question, and we'll chuck it in for next week. But that will do us for today, guys. Thanks very much for listening, and we'll see you guys next week.
See you guys.